Saurabh Mukharjea, good morning. Thank you for joining us. What does one do, Saurabh, in a market like this? You know that there is going to be uncertainty. It's a dull market. You cannot go short in a dull market, but you cannot participate in a dull market. Valuations are not that great, but the hope that tomorrow will be better than today is still alive. How does one make money in this kind of a market?
I think I partially agree with you about the dull market point, and I'll partly disagree as well. Where I'll agree with you is that it's a dull market in the sense that, like we've seen in the last 6-7 years, I think we are set for another year of weak earnings growth. Even if you factor in a rebound in the private sector banks' numbers, I don't think we'll be seeing Nifty earnings growth too high, too far above the 11-12% mark, and clearly valuations are stretched in that regard and have been stretched for the last couple of years. Where I don't think it's a dull market and I don't see the uncertainty being as big as others are making it out to be, we're in a classical Indian setup, a classical setup of high government spending, a rising cost of money, consumption in decent shape, small ticket consumption in decent shape, private sector banks all set to have a good couple of years as NBFCs and PSU banks struggle, and the currency set to weaken, thus favoring exporters. So IT, pharma, private sector banks, FMCG sectors that investors have known and loved for a long time, I think are set for a good couple of years. And in that regard, I'm not so sure the outlook is as uncertain as some are making it out to be.
Okay. Saurabh, we've discussed this again and again, but since everybody is talking about it, I am forced to revisit the market and the election correlation. Both of us know that this is a very short-term, from a market standpoint, this is more like a short-term adjustment. It could last for a month, it could last for 3 months, but that's the max how markets have really impacted, that's the max how elections have impacted the market. So if the evidence is backing the fact that election is more like a short-term stroke sentiment market event, why is there so much of uncertainty? Why is there so much of anxiety? Why is there is so much of anxiousness? I was at a Birla event of where 2,000 FSAs attended it, and the message which I have come back with is that election ke baad hi market dekhenge. Why is that?
I think Nikunj, it's a natural human sentiment. We are caught between greed on the one hand, the greed that if I could get in early before the result, and if I could second guess the result, the natural tendencies to believe I could make potentially a lot of money in the next couple of months. And the fear obviously is, I know that earnings have not been the best for the last 6-7 years. I know the earnings outlook even now, even with an NDA victory, is not the greatest. And I know PE multiples are stretched. So hey, could the market correct sharply? And it's a natural human tendency. And my view, as I've said on your channel for several years, is this sort of investing is as best seen as a hobby. If you want to professionally invest or make good money with your savings, best to buy the classical compounders in our country, which really are not swayed by elections. I mean, kids will have baby milk powder even after 23rd May, regardless of who wins the elections. And in that regard, it's difficult to see why Nestle's earnings, just to take an example, why Nestle's earnings should be swayed by the identity of the victor on 23rd May. Similarly, houses will be painted after the election regardless of who wins, and Asian Paints' earnings therefore should hold up regardless, right? But the human mind doesn't like boring things. The human mind wants excitement. Excitement comes from these sorts of big ticket events, and people try to gamble around it. So it's natural to want to do so, but it doesn't make you a great deal of money if you want to gamble. It's a good hobby to have, but that's not professional investing.
Good morning.
Afternoon.
An interesting note by CLSA this morning where Chris Wood is saying that the pain has been further exacerbated in the NBFC space by the blow up in the NBFC issue since the IL&FS crisis. He's saying that he continues to see a slowdown in consumer credit caused by cutting funding to NBFCs. Do you think the smaller NBFCs, which do not have a strong parentage, have been taking the brunt already and would continue to do so in the near future as well?
I think around 2 years ago, I started sounding the alarm bell on various TV channels about the parlous state of the NBFC sector and the associated problems with the debt mutual fund sector. The debt mutual fund sector very much is the funder, the banker to the NBFCs and the housing finance companies. Clearly, a lot of these businesses have unviable business models. You can't be borrowing money in the short-term money market and be lending them for 20-year home loans. It made no sense. It makes no sense. I think we are halfway through the blow-up. My reckoning is the rest of the blow-up in the sector will happen in the 6-7 months following the elections. As we read every day in the newspapers, debt mutual funds are having a serious problem with the exposure to the sector and to other promoter funding vehicles. I think those problems will exacerbate over the next 6 months, and I think we are only halfway through what I think will be a brutal shakeout in the HFC and the NBFC sector. There will be a few champions who will be left standing, but I think off the top of my head, I can't see more than three credible NBFCs surviving this brutal shakeout over the next 2 years.
Saurabh, you have mentioned that you do find comfort in private sector banks. Some of the IT names, consumption as a pocket as well, and pharma is what appeals. But let's talk about IT in specific. Given that most of the numbers have come out from the large cap companies, and the sense is that the growth momentum for the long term seems to be fairly strong on the deal pipeline as well as the digital foray. How have you assessed the earnings so far, and do you have any preferences within the pack?
I think a couple of things to remember. Indian IT obviously is a reasonably commoditized sector, in that our IT firms are not offering some cutting edge science and technology, right? Therefore, cost efficiency and currency is central for them. A weakening rupee is super helpful for Indian IT, right? The 63 to 70 slide in the rupee, and I think over the next 12 months the rupee looks destined, to my mind, to head for 75, 76. That sort of backdrop is a natural and a super powerful tailwind for Indian IT, regardless of what is happening in America or Europe. Secondly, basis what I read on tech commentary, I'm not a tech expert myself, but what I read on tech commentary, now that the digital blueprint for the Western world is pretty well laid out, it's relatively clear that the Accentures and the IBMs who sort of rule the roost are now once again back in the mode of giving plenty of work to the Indian IT services firms, and Indian IT services are back in the groove of executing low-cost projects on a well-worn template. And finally, scale gorillas the world over, low-cost scale gorillas the world over are well placed to benefit from the global supply chains, and to my mind, TCS as the dominant scale gorilla in Indian IT, and indeed TCS as a scale gorilla in global IT is, I think, a natural beneficiary of that climate. So currency, the maturing of the new digital blueprint, and scale, I think those are the three things to look at. And to my mind, TCS is the best play on that. One disclaimer, it is something that we've recommended to our clients over the last couple of months, and therefore, in some regard, I'm already talking my own book. But I do believe Indian IT generally is well placed over the next 12 months, and TCS, to my mind, is the best play.
Time and again I keep on hearing this argument that okay, Indian IT companies are getting the commodity way. They are the ones who don't have a cutting edge. They are the ones who are not in product. But when I look at the reality, and I'm just keeping the tier 2, tier 3, or even A minus IT companies aside. Look at TCS. You like it, but I think our viewers should also should also acknowledge that this is a business which is giving you free cash flow. The return ratios are strong. Cash is coming back to the shareholders, and margins are between 25 to 28%. How many businesses in the world, Saurabh, can grow at 8, 9, 10% at that run rate and give you dividend and cash back or buyback every 2 years?
No, I absolutely agree with you. I think, Nikunj, I think the financial strength of these franchises is unbelievable. If I hark back to my book, Coffee Can Investing, the two things I look for is return on capital employed consistently above 15% and revenue growth consistently above 10%. TCS's ROCs are in the vicinity of 30%, and at the moment they seem to be well set for dollar revenue growth of 10%, which should be rupee revenue growth of at least 12-13%. So this has all the hallmarks of what is already a legendary franchise, and it has in it the ability to be a coffee can franchise potentially over the next decade or so.
Sort of what one is seeing interestingly in this earnings, the few that have come out, is that there is this sectoral churn. And within sectors also, there are those few odd companies that are emerging as leaders. One saw that recently play out with cement, wherein you had one ACC which saw a fair amount of cost pressures, etc., and the margins were bogged down. But then there was Ultratech Cement, which saw blowout, earnings. Do you sense that some of the others, like perhaps in India Cement, also could replicate the same kind of performance?
I think it's entirely possible, Aisha, that we get quarter to quarter numbers which favor certain players. I think you're right. Ultratech's numbers do look very impressive, but I think the longer term picture is worth looking at, because to make really good money, you need to you need to settle down on, say, 10 large bets on high quality firms, and ride with them. If I look at the cement sector, I struggle to find too many companies where I can consistently see ROCs, return on capital employed, north of 15%, and consistent revenue growth in excess of 10. To take Ultratech itself, ROCs have struggled to get into double digits, forget about exceed 15%. And yes, they will have, they've had a good quarter, maybe they'll have several more, but I don't see in the franchise the makings of a really lucrative stock. It could have a good 1 or 2 year run, but it's not one of those stocks where I can buy, put it away, and consistently expect 25% compounding. I think that's the big thing to look out for. Look for stocks which can consistently give you 20-25% compounding on the basis of really superior underlying fundamentals, which can grind out superior performance year after year. Asian Paints or HDFC Bank being classic examples of that.
Saurabh, any more additions to your compounder list? I mean, I remember a few names from there. You had Abbott, you had Asian Paints, you talked about HDFC. Any new additions?
I think your memory is very good, Nikunj. So I think soon I will run out of names to give you. But I think a company which we haven't discussed on your program is Speedlite. It's to my mind, it's a classic coffee can compounder. Market share of 70 odd percent in adhesives. ROCs north of 25%, and whilst growth hasn't been the greatest over the last couple of years, I think Pidilite's ability not just to dominate adhesives but now the waterproofing business as well bodes well for the future. So well-run firm, and it forms part of our portfolio.
Saurabh, just to top it up on this whole argument of valuations, Pidilite, PNG, Asian Paints, these are franchise if you own for your grandchildren also, you will not regret those decisions. But the problem is that lot of us are not investing for our grandchildren. We are investing for ourselves, which means that we don't have a 10 or a 15-year view. We have a 2 to 3 year view. So on a 2 to 3 year view, do you think a Pidilite and Asian Paints or perhaps a PNG will make money?
I'm not so sure about PNG. I have to confess I don't know much about the name. But on the other two names you mentioned, if you look at, if you get a chance to read Coffee Can Investing, you'll see that even over a 3-year period, even if you do rolling 3-year returns on these sorts of companies, you tend to get very good returns. Provided you're willing to give it 3 years, not only do you get good returns from these sorts of franchises, the HDFC banks, the Asian Paints, the Pidilites of the world, the volatility of your returns is as low as a Government of India bond. So what I've consistently tried to explain to people about this form of investing is you're getting returns well ahead of the Nifty, 6, 7, 8 percentage points ahead of the Nifty for half the volatility of the Nifty. For a government bond volatility, you get 20-21% returns pretty consistently, even over periods as short as 3 years. And I think that's all really one can ask for in equities. If you're getting returns well ahead of the Nifty, ahead of the benchmark, for half the volatility of the benchmark, that's as close to a free lunch as people like me can get to in the Indian stock market.
You put it fairly well. Thanks very much then, Saurabh, for joining in and giving us that take on individual sectors where you're finding value as well as the overall outlook on the equity markets.